If I could have your attention, please. I want to welcome you very warmly to the invited session on communication, expectations, and monetary policy here at the EEA annual meeting. We're very pleased to have three distinguished speakers, Luis de Guindos, who is Vice President of the European Central Bank, Ricardo Reich, who is Professor of Economics at London School of Economics, and Silvana Tenreiro, who is an external member of the MPC of the Bank of England, and also Professor of Economics at LSE. And we have the following plan. Each of the three will give a short presentation, short introduction of 10 to 15 minutes. And we will then turn to the floor, turn to you for questions. So hopefully we will have at the end 15 minutes or so to collect questions and have an open dialogue. Without further ado, we will go in the order of alphabet, and I would first ask Luis de Guindos to give his introductory statement.
Good afternoon, everybody. Every year, the ECB organizes a policy panel at the annual Congress of the European Economic Association. And the intention of these panels is to combine the results of research and the views of policymakers to advance our thinking on a topic of policy relevance. This year, it has been straightforward to decide on such a topic. Communication and expectations are central to the conduct of monetary policy. And there is a substantial body of research that allows us to have an informed discussion on this topic. As you know, central banks communicate with many different groups of economic actors. Let me focus my remarks on two such groups, namely participants in financial markets on the one hand, and the general public on the other. There is a tight two-way relationship between central banks and financial markets. Extensive research has dealt with the flow of information from central banks to financial markets, as has shown that central banks' communication exerts strong effects on financial markets. For instance, as central banks have become transparent about their objectives and their reaction functions, the inflation expectations that are priced into financial assets have become better anchored. They have become less volatile and broadly aligned with the central bank's inflation aims. Beyond this, markets also react strongly to the communication of the central bank's assessment of the current conjunctural situation and the economic outlook. At the same time, the influence also goes in the other direction. Financial markets send signals to the central bank, which constitute a central input to decision-making. It is important for us to get the market view about where the economy stands and where it is heading. This helps us cross-checking our own views, and it provides us with a benchmark against which we can communicate our own assessment. For instance, our projections take into consideration market expectations about the future path of short-term interest rates, oil and non-oil commodity prices, stock market prices, and the evolution of the exchange rate. To put it in other words, central bank communication has to be two-way. The central bank talks and listens to financial markets at the same time. There are 2 points in this relationship which I want to highlight. First, by influencing asset prices and expectations of financial market participants, the central bank affects the very signals which it wants to use as input to its policy making. This has become known as the echo chamber effect. The louder the central bank talks, the more likely it is to hear its own echo. This is particularly prominent in times when the central bank gives a strong forward guidance. ECB research has shown that in such circumstances, market expectations become cemented, so they do not longer respond to news about the macroeconomy. This is something we need to keep in mind when designing our communication strategy and when reading the signals from financial markets. The more forward guidance we give, the less informative our market signals for gauging the state and the expected evolution of the economy. A second point is that even if central bank transparency and communication has helped anchoring market-based inflation expectations, they do remain rather volatile. The volatility itself is a signal that is useful for us to understand. However, even if markets are volatile, central bank policy cannot be volatile. Hence, we need to look through some of this volatility to get a feeling for the underlying pricing that could result in the absence of short-term market moves that are likely to revert quickly. The echo chamber effect and the inherent noisiness of market signals are reasons why we need to take the expectations that are priced in financial markets with a pinch of salt. This means that we need to also rely on other sources of information to ensure that we conduct a robust monetary policy. The incoming macroeconomic data are one such source. As we keep stressing, our monetary policy is data-dependent, not market-dependent. Indications for market expectations cannot replace our policy judgment. Another way of robustifying our analysis is to look for expectations beyond those expressed in financial market prices. This brings me to the second group of factors I want to mention, the general public. Central bank communication with the general public has only more recently gained the attention of academic research. Also here, we need to think of the interaction as a two-way street. On the one hand, central banks have a lot to learn from consumers. For instance, consumers form inflation expectations that can tell us to what extent the central bank's inflation aim is perceived to be credible. Variations in consumer inflation expectations are also an indicator that central banks monitor because these affect household decision-making and do therefore shape economic performance. While we have ample data available on expectations formed in financial markets, we know much less about those of consumers. And in order to bridge this gap, we have just recently started to develop a new consumer expectation survey. This project is still in its early stages, but it will provide us with a tool to collect information at regular intervals on household expectations and decisions, covering a broad range of topics, including household income and finances, consumption, inflation, labor, and housing and real estate markets. This will allow deepening our understanding of consumer behavior in the euro area and give us up-to-date information on expectations that can fit into our policy analysis. On the other hand, central banks do not only want to learn from the general public. They also try to actively reach out to it, making this a two-way interaction. They do so for several reasons. First, to manage expectations about economic outcomes. Not only inflation expectations, but also expectations about financial stability and the safety of individual banks. Second, independent central banks need to make sure they are accountable to the public. For both objectives, first-order importance should be given to making sure the general public understands the mandate of the central bank and trusts its commitment and ability to deliver on its mandate. There is ample evidence that this matters. ECB research finds that general trust in the ECB has an impact on consumers' inflation expectations in two different ways. First, it lowers their uncertainty about future price developments. And second, those who trust are less likely to have inflation expectations that are far from the ECB's inflation objective. In other words, trust in the ECB helps anchoring inflation expectations around the ECB's inflation objective, as agents are more likely to view deviations of inflation from the target as temporary. And it matters how the central bank drafts its communication. Research has shown that relatively simple but targeted messages are particularly effective in shaping consumers' inflation expectations. So it is important to increase awareness about the central bank mandate and to enhance trust in the central banks. Therefore, we have stepped up our efforts along these lines in several dimensions. Let me highlight three of them. First, we have developed educational material about the ECB and its policies that is made available on our website, for the young generation in particular. Second, we are much more present in the social media. This is an important channel whereby central banks can reach out a relatively broader audience directly. without intermediaries, and interact with the public, for instance, through our Q&A sessions on Twitter. And third and finally, we are also working to make our regular policy publications more accessible to the general public. Our most recent financial stability review, for instance, is presented on the ECB's website in a way that makes the content more easily understood and interesting. Let me conclude by reiterating the central role of expectations in the conduct of monetary policy. We are well aware that our communication influences the very expectations that we want to use as input into our decision-making. We do therefore need to ensure that we base our decisions on a multitude of information, covering not only financial markets and experts, but also the general public. At the ECB, we are enhancing our toolkit for the communication with the general public in two ways, both by collecting more information about consumers and by targeting some of our communication efforts more directly at the general public. I am confident that this investment will pay off and help us achieving three objectives at the same time: being a trusted institution, being accountable to the public, and maintaining price and financial stability. Thank you very much.
Thank you very much. We will turn straight to the second speaker, to Ricardo Reich, who also has a few slides he would like to show.
I change here. Great. Okay. Well, thank you. Thank you very much for having me in this panel. The title is Communication, Expectations, and Monetary Policy in this panel. I want to focus a lot more on the expectations to then talk about the monetary policy and conclude with the communication in my 10 to 15 minutes. And the reason why I want to follow that order is that I am somewhat worried with the current outlook for monetary policy, both in the Eurozone as well as in the US. I want to share with you why I'm somewhat worried and why expectation and communication are central to those worries. I think very few people here in this room who have studied some monetary policy will disagree with the claim that controlling inflation is the main goal of a central bank, and especially, and for the purpose of this talk, I will speak only about long-run inflation, that is inflation on average, if you want, over the next 5 or 10 years. Over these 10 years, one might even argue that not only inflation is a main target of the central bank, that perhaps it's even the sole target of the central bank. That over 10 years, either the Phillips curve is vertical, or if not, that there's really no trade-off between controlling inflation and achieving macro and financial stability. And let me emphasize again, over the very long run, even if in the short runs, one has these trade-offs. Given that controlling inflation is the target, well, one very quickly ends up with thinking about controlling long-run inflation expectations. Controlling over the long run, as for instance the great British economist David Hume taught us many decades ago, there's a fundamental indeterminacy of what inflation will be in economic models, insofar as inflation will be what people expect it to be. And in turn, they will expect whatever inflation happens to be when one thinks about the long run. Therefore, controlling inflation over the long run is ultimately about controlling expectations of inflation over the long run. If one looks at the great accomplishment of central banks in the last 30 years, the control of inflation, the lowering of inflation, that was intimately tied to the lowering of long-run permanent inflation. As Mario Draghi himself said, what is key throughout all policies, all crises, sovereign debt or not, is to control and anchor long-run inflation expectations. And what I plotted for you there is my go-to model of inflation dynamics. The simplest model is to start with annual inflation and say that it is given by a Beveridge-Nelson model, the sum of a permanent plus a transitory white noise component when one thinks at the annual level, and simply estimate that Beveridge-Nelson composition to figure out what permanent inflation is as opposed to transitory one. And the big fact is that starting in the 1980s and as much as all the way until the 2000s, the permanent component declined, and especially the variance of that permanent component declined relative to the transitory component, both in the US where we have the longer period, but also in the Eurozone. And it's been that stability of the anchor, which itself has stabilized longer inflation expectations, that has allowed for the great success of the last 20 years, where inflation has been remarkably under control. But if one looks at the more recent past, is the anchor of long-run inflation expectations still on the 2% central bank target? Well, if we look at the Eurozone and the survey professional forecasters there, where one asks the forecasters, what do you think inflation will be in the long run, understood as roughly a 5-year horizon, one ends up with measures of longer inflation expectations that are relatively still anchored around the target, even if in the last 6 months, deviating a little bit. We're now at 1.7% in the median, as opposed to the 1.8, 1.9% through which it traditionally hovered. Likewise, in the US, if one looks at again at the survey pressure forecasters run by the Philly Fed, which now asks over the long run, being over the horizon of the next 10 years, you see a very tight anchoring around the 2%, precisely the target that the central bank has. And so looking from this perspective, you would say the conquest of the 1980s and 90s of lowering long-run expected inflation is still holding. And yet there are reasons to be concerned. And the reasons are that, or to start with, is that these last two pictures are probably not the right pictures to look at when one looks at long-run expected inflation. Households are inattentive, information is sticky, and especially when it comes to asking people to forecast what they think will happen over the next 10 years, we see an enormous amount of inattention and stickiness as they discount the benefits of having a very high forecast which are accruing in the future, with the large short-term costs of coming up with those good forecasts right away. Indeed, when one looks at a country whose anchor deviated from target persistently, Japan, starting approximately 20 years ago, one sees precisely that by the time that the long-run inflation expectations in surveys fell from their 2% to hovering around 1%, which happened if you look at the consensus economics forecasts somewhere between 98 and 2002, it was by then far too late to do something about it, and the Bank of Japan has spent the last 20 years trying to correct that. One wants to look instead at somewhat more forward-looking measures. And a more forward-looking measure comes from more attentive agents from looking at markets, and in particular at swap markets, where I've plotted for you here the 5-year forward, that is the expected inflation starting in year 6 to year 10 as of today. And there what one sees is a persistent decline in the euro area over the last 12 months, and especially over the last 6 months, where nowadays expected long-run inflation is at around a little bit below 1.3%, at very low level. In the US, it is not quite as low, but again over the last 6 months, maybe 12 months, there's been quite a bit of decline in these market measures. Now, what could explain this big decline in market measures that is not reflected in the survey measures? A simple story could be that, and one that's often used is, well, the inflation risk premium has fallen, and indeed now is negative. The markets are expecting less than what the surveys do. That's, by definition, a negative inflation risk premium. Therefore, this may just reflect some change in risk aversion. Maybe people are just more averse about a scenario in which we'd have deflation with stagnation. That would generate a negative inflation risk premium. And therefore, there's not much to worry when it comes to the anchoring of expectations. I'm quite skeptical of that, as in my recent research, I've learned to be skeptical through my recent research. And why? Because to generate a change in 60 basis points, or even as much as 100 basis points in the compensation for inflation risk, would require an enormous change in risk attitudes towards inflation. Quantitatively, it is very hard to explain why is it that you'd have a 100 basis point increase in absolute value or decrease in the inflation risk premium when one looks at inflation options, for instance, the standard deviation or variance of those options has increased by something like 0.3%. You'd need the standard deviation of the options to increase by something like 4 or 5%. In perhaps simpler terms, the price for trading an option that inflation will be below minus 2% in the US or the Eurozone in the horizon of 5 to 10 years has barely changed, and those are barely liquid markets. That is, you can barely say anyone who will conceive of that possibility as being very high, which seems inconsistent with an enormous increase in what the risk premium or compensation for risk would be. Rather, when one tries to explain what's going on with this picture and this picture, instead, what one ends up with is, by looking at the data on surveys of market participants, is rather that the people in the market, in their subjective expectations, are becoming very pessimistic about the future of inflation. Subjectively, not risk-adjusted. They're becoming very pessimistic, and moreover, when one looks at the distribution of answers, say to the ECB survey forecasters, but perhaps more accurately, say to the New York Fed survey of primary dealers, is that one sees one sees a big change in skewness. The emergence of a mass of traders, of informed agents, who are putting a lot of weight on inflation being between 1 and 1.5% over the next 5 to 10 years on average. Again, this is all on long-run inflation expectations, not on short-term. Okay? And that is very worrying, because that is a sign that the anchoring inflation expectations, the anchor which has been on target of 2% for the last 20 years, may be on its way to falling to 1.5% or 1%. And if one looks at the experience of when that does happen, pain follows, in the sense of it becomes very hard to bring it back or anchor. So what can central banks do about it? What are policy actions from the past in reacting to this? A good example comes with the ECB, because if you look back at my picture, which I'll flip through quickly, the same thing happened in 2015. What did the ECB do in 2015? It was extremely aggressive in terms of expansionary monetary policy. Forward guidance was extended, QE got started, and in general, the ECB responded through extremely aggressive expansionary policy in a way that ended up proving the markets wrong, as the markets reacted back in their subjective beliefs back into the target. So first lesson, be aggressive. Second, going back to the Bank of Japan in the late 1990s. Okay, fine, okay, thank you. Going back to the Bank of Japan in the late 1990s, the BOJ in the late 90s and early 2000s was far too worried with financial stability. Maybe this will ring some bells. Far too worried with financial stability of different forms, with how to deal with the breakdown of banks and the dealing with NPLs, such that it was relatively, let's say, not super devoted to the target of bringing it back to 2%. What's wrong with inflation at 1.5 or 1 was sometimes said at the time when discussing the situation in Japan. There's nothing much wrong about it. And here we are 20 years later with inflation still stuck at around 1 and 1.5. So if you really want to be back to your 2% target, be devoted to your target. The UK in the last 2 years also gives some interesting policy lessons to this, in this regard. In the UK, on account of Brexit and all the political changes around it, there was a large depreciation of the pound, and as a result, a large increase in imported inflation, simply through the depreciation of the pound. Inflation went up all the way to 3%. And there's nothing wrong with that. And unlike the ECB, unlike the Fed, inflation expectations in the long run in the UK, as judged by financial markets or surveys, have been actually very well anchored around 2% without suffering from the same problem as the others have. There's nothing wrong with inflation going to 3, even 4%, if you're trying to convince markets that you're happy with 2. If you are radical about a decimal above 2% being a mistake, then it's going to be very hard to convince people in the long run, on average, given shocks to inflation, you will average 2%. It just doesn't work that way by the simple laws of statistics. If you never exceed 2, you will not average 2 for a noisy process. A fourth lesson comes from the 1980s, and in this case, from if you want, trying to do the symmetric art, trying to use some symmetry, given how we conquered inflation back then. Back then, the key to lowering long-run inflation expectations, the key to anchoring them on target, was to get rid of fiscal dominance. It is a foolproof way to generate inflation than to allow the central bank to be fiscally dominated by the fiscal authorities. Now, in general, this is often not a good idea because it is very hard to control how much inflation you get out of QE for the people, funding deficits, or generating seniorage to fund expenses. You can very easily end up with 20 or 200% inflation. However, having this, understanding that the monetary policy is never completely independent, and as an escape clause, if inflation expectations do become anchored well below target for a prolonged period of time, that having some fiscal dominance, that is fiscal monetary interaction having its role, is not something to completely discard off the table. Let me then talk about communication. So I've talked about expectations. If I told you about my concern about expectations becoming anchored below the target, to control especially a long-run expectation, not a short-run, but a long-run expectation in which we're really communicating about regime, about policy actions, it is obviously central to communicate. Communication is nothing but the attempt to influence expectations. It is central to state, explain, and clarify what the target is, to say which tools are being used and how, and to link those tools to targets using economics, logic, judgment, and data. But should a central bank today try to be relevant in the sense of reaching a broad section of the public? Sadly, the only way to be relevant, to reach the first page of the newspapers in today's media society, is to be controversial or to talk about controversial topics. If you want to be relevant and reach a broad cross-section of the public, just talking about minute details about the monetary transmission mechanism is not going to work. As many central banks all over the world start being so worried about talking to the public directly, I worry a lot that they will instead be talking about lots of topics on which a central bank has very little control over, but those are the ones that will attract attention, and in doing so will lose the trust of the public. Likewise, many central banks are devoted now to making their communication simpler through cartoons, music video clips, and all kinds of different things that you can find on YouTube if you look for different central banks. I applaud that desire. After all, it's our democratic institutions that have to be accountable. But when one looks at those videos and those cartoons and others, the simplicity ends up translating itself into a simple message. Trust us. We're in charge. We'll take care of things. We'll go around the world, sell books, and tell you about how we saved the world 10 years ago. We'll keep on saving it, and we're the people to trust, the all-powerful central banker. That simplicity is one that I don't find desirable. Simplicity about objectives, about tools, about the economics linking them, that falls within your mandate. Telling the public that you have godlike creatures features to control crisis, avoid any crisis of any kind, and have saved the world and will keep on doing so, is the road to, again, lose trust which will be sorely needed, I hope not, but I fear will, to raise long-run expected inflation back to anchor. Thank you.
Thank you very much, Ricardo. Then we have the third speaker, Silvana Tenreiro.
Good evening. So, oops, how do I move here? Okay, so I'll start by saying that central banks have made a lot of progress over communications and transparency in the last 20 years. And we've seen that on many dimensions. But today I'll try to talk about the challenges that remain. And I will focus on two particular ones that I think are important. The first one, and this is more focusing on the case of the UK, communication of the inflation target. There is still a lot that can be done to improve people's understanding of inflation and the impact it has on their economic decisions, particularly in certain segments of the population. And the second one is communication of how we set monetary policy, or in other words, the reaction function in the jargon. And on this, I'll talk about the Phillips curve, which is one important element behind the thinking of many central banks, and it has been the source of confusion in recent policy debates. So let me start with the inflation target. As many of you know, since the Bank of England was granted operational independence in 1997, CPI inflation has averaged exactly 2%. That's depicted in the red line. Inflation stayed within a narrow range of the 2% target over this period, which contrasts significantly with what happened before 92, when the inflation target was introduced. In the period from the 70s to 92, inflation was very volatile and the level of inflation was much higher. Since 92, there were some developments in the framework, including the switch from the retail price index target to the CPI index targeting. But overall, the pattern for the two indices is very similar. Inflation fell and became much more stable since the Bank of England's independence. Now, despite this stability and low level of inflation, perceptions of the inflation have not tracked the target or the CPI measure. If you can see it in yellow in my screen, but I think it looks more like greenish, this line shows perceptions on average during this period that spans from 2004 to today, inflation perceptions of expectations by households, what they thought inflation was on average 1 percentage point above the CPI inflation rate. And that gap in perceptions also fed into inflation expectations 1 year ahead. So on average, inflation expectations, again, are 1 percentage point above the 2% target. Now, when we think about what impact this can have, perhaps not too big in terms of the macroeconomy. Typically, we think that all else equal, higher inflation expectations will lead into lower savings and higher current spending. But given the patterns that I will show, it's possible that for the macroeconomy, that doesn't make a huge deal of difference. However, it does make a difference if we think about some individual household decisions. So let me show you a little bit about the distribution behind these averages. This graph here shows the one year ahead inflation expectations. And as you can see, I hope the colors don't show very well, but in here, about 1/3 of the respondents to the survey have inflation expectations above 4% during this period, going from 2006 to today. Even though inflation only reached above 4%, less than 10% of the time during this period. Moreover, we have almost 20% of the respondents that have no idea what inflation was. And this is in a survey that asks about inflation, price increases. If we ask directly about inflation, that 20% jumps to almost 40%. So there are these gaps in understanding. So let me talk a little bit about what the literature has said about what's behind these big dispersions in expectations. So one explanation is that, well, perhaps people, when they respond, they're thinking about different price indices. Expectations seem to track more closely the retail price index, which is on average slightly above the CPI in terms of inflation. However, that cannot explain the big gaps when people are far above 4%. Another possibility is that they are looking at their own basket of goods, and maybe there are households with different individual inflation experiences. But again, that cannot average to such big differences with average inflation. So that alone cannot explain the differences. The literature has also mentioned behavioral biases, perhaps items that are more salient, more frequently bought, or more visible, like petrol and food, get a bigger weight in the responses. Another possibility is the environment. In an environment with low and stable inflation, people are rationally less attentive, so they might be less informed about what inflation is. That relates to some of the work that Ricardo has done on inattention. And another one that seems very, very important, and I've talked about in some work I've done, is financial literacy. There is a significant fraction of households who really don't know what inflation is or might be and have difficulty understanding the concept. I should say that that tends to relate to the levels of income and education of the household. So we see differences in those. Households with lower education and income are more likely to respond that they don't know what inflation is. Here I'm showing you some differences along the age dimension. Again, young people seem to be less informed about what inflation is. So the shares of people who have no idea what inflation is almost 30% among the young, and that contrasts with the older segment of the population. Women are also more likely to say, twice as likely to respond that they don't know what inflation is than men. So we have these big gaps. These are concentrated in some segments of the population, and there's a need to perhaps act more targetedly to reach those groups and try to bridge those gaps in understanding. Now, let me turn to the other challenge that we have, and this concerns people that are very well informed, including academics and practitioners. And that has to do with, again, how we set policy or the reaction function. So this slide here shows you a snapshot of some of the discussion that has been going on in the media on the Phillips curve, whether it exists or not. A lot of discussion. There are some people in the room in the pictures here. Ricardo, you're here. It appeared to be the one point in which Ocasio-Cortez and Trump's advisors seem to agree. There's no Phillips curve, according to both. So let me tell you a little bit what's going on here. So in the last few years, a number of academics and practitioners have argued that inflation appears to follow a completely exogenous process unrelated to measures of slack, such as employment or unemployment or the output gap. And this related to the Phillips curve, of course, which is the positive relation between inflation and the output gap, and the conclusion that this Phillips curve has flattened or even disappeared. Now, many commentators went even further to argue that this disappearance or flattening of the Phillips curve poses a challenge for the framework used by central banks today, which relies heavily on the Phillips curve. It's one of the key building blocks there. So in a paper I wrote with Michael McLeod from the Bank of England, we argue that that conclusion is misguided, that the fact that we don't see a relation between inflation and slack is precisely what you should expect from a new Keynesian framework when policymakers are optimizing. So let me explain a little bit what we are saying with some formulas. So here we use a simple new Keynesian model, as simple as it gets. The central banker has a standard loss function. Pi here is deviation of inflation from target, and x is deviation of output from its efficient level, or the output gap. So let me concentrate on the solution under discretion. The central banker minimizes period-by-period losses, subject to an aggregate supply relation, or Phillips curve. And this supply curve is very intuitive. It says that when the output gap is positive, or output increases above its potential, that puts upward pressure on costs and causes inflation to increase. Importantly, this Phillips curve is also shifted around by inflation expectations, and Ricardo has talked about them and how they impact on inflation. And they're also shifted around by cost push shocks. Anything that drives a gap between inflation and the output gap is collected here in this term U. The solution to this problem is a targeting rule, which says that, well, when inflation is set to go above target, the central banker will withdraw stimulus from the economy and cause the output gap to fall. So this solution, or targeting rule, imparts a negative correlation between inflation and the output gap. And I plotted here the two relations, the upward sloping Phillips curve and the downward sloping targeting rule. In equilibrium, we only observe the intersection between these two points, these two curves. And so if we want to identify the Phillips curve, we face a standard identification problem. And this clicker, I'm not sure if it works. Yes, it does. And obviously, this identification problem is made worse if these cost-push shocks are shifting around. Because if that's the case, then a naive econometrician will be more likely to identify the targeting rule with the wrong slope rather than the Phillips curve. Right? Now, the output gap can be affected by many, many factors, and monetary policy tried to offset some of them. And the best monetary policy can do is portrayed in this line, the red line. That's the optimal policy at any point in time. If there are cost-push shocks, or any shock that drives inflation and the output gap in different directions, well, monetary policy cannot do much, cannot stabilize both at the same time. It enters into this trade-off territory. So the best monetary policy can do is basically stay in that curve. And just to illustrate the role of this, I plotted here different possibilities using the very simple model that I showed you before. The blue line shows a case in which the cost-push shocks are very small, and actually monetary policy is very erratic. It moves around very much. It might be because policymakers are making mistakes, or because there are errors in forecasts, revisions of the data, et cetera, et cetera. In that case, you can identify an upward sloping relation, or the Phillips curve, something like the Phillips curve. The red line shows the exact opposite. In that case, monetary policy shocks are very small, but cost-push shocks are driving around. So if you're a naive econometrician, you will estimate this relation. And finally, the green one shows some mix of the two. And again, this will depend on parameters. In the standard parametrization of the simple model I showed, you will actually end up estimating, again, a negative slope. Or it could be flat or zero if you put zero weight on the output gap in the objective function. You just care about inflation. So in that extreme, if you only care about hitting the target of inflation, well, inflation will be uncorrelated with anything else. And we should see a very flat Phillips curve. Rafaela is laughing. It's very obvious to her. 1 minute. OK, so let me just conclude. We need more econometricians like Rafaela speaking up and saying, come on, guys. The reason why you don't see a Phillips curve is because you're not doing your econometrics right. OK, so just to conclude, central bank communications have come a long way. There's been a lot of improvement, but there's a lot more that can be done to serve the public. Improving financial literacy is one of the biggest challenges. The Bank of England has tried to do so by improving the education outreach. But there is scope to do more, and there is scope for others to join these efforts. Universities, high schools, employers, and so on could help on this and help improve the decision maker of many people who are clueless when it comes to financial decisions. On the reaction function and the understanding of what central banks are doing, again, the Phillips curve has been a source of confusion. There's been a back and forth among academics, policymakers, the media, and there's more that can be done. And this debate has been among the best informed in society. So this brings me to the more general challenge. We need ways to communicate difficult or more complex ideas in a way that is clear to practitioners. And yes, I mean, we are more increasingly using Twitter and other forms of media to social media to communicate ideas. Sometimes it can be challenging when we need to use more than 140 characters, but that's the challenge. Thank you.
Thank you very much to all three of you. We have now a bit of time left, and as a moderator, I want to pose a question to each of you, but then immediately before you answer, make a big round, collect 3 or 4 questions from your side, and then allow the 3 of them to answer collectively. And to very briefly, for me, to summarize, I think it was very complementary presentations of the 3. That looked at different elements. Luis de Guindos looked very much at the target of communication, and you highlighted in particular also the importance of communicating with the general public. One interesting thing is that, in particular, now I bring in a bit of a German bias, is that people are very much worried not so much about inflation at the moment, but actually about the interest rates, right? They're complaining, they say, I'm getting no interest rate on my saving account, and actually there has been now discussion saying, oh, banks might actually impose a negative rate even for small savers. And so my question would be, what do you answer to them when they are complaining, oh, interest rates are so low? Is it really the ECB? Is it monetary policy? Or who really bears the responsibility? To Ricardo, you talked a lot about different measures of inflation expectations. Now, the 5-year forward, 5-year out, you presented how that has declined very quickly, and that risk aversion really cannot be the driving force. I want to push you a little bit on the solutions, and you had some of them, said stick to the target, be aggressive, and the symmetry of the target. But you also mentioned that you mentioned fiscal dominance, right? That monetary policy dominance, as we used to know it before 2008, really doesn't exist to that extent anymore. What do you do actually as a central bank when fiscal policy doesn't do its job, maybe is not aggressive enough? And arguably you could say this is a problem for at least part of the developed world, in particular for the euro area. And again, having a German bias, if you look at Germany in particular, and an environment where inflation is increasingly determined by global factors and less by domestic factors. And maybe a quick follow-up question also for Silvana. I was really intrigued by your measures of inflation expectations and saying, oh, actually consumers tend to overestimate inflation. And so that kind of gives us the opposite picture from survey expectations of professional forecasters and also market-based measures. And so maybe a little bit to understand better, might that actually not be a good thing, that people overestimate inflation in terms of forming wage expectations, pushing for higher wage increases, so that actually this may help central banks achieve their inflation objectives. So these are my 3 questions. I now would like to take 3 questions from the floor. I would like to ask you, those asking a question, to really ask a question and not make a statement. Please briefly state your name and affiliation, and then we collect 3, and then we go into this round to the 3 panelists. And if you are very brief in your questions, then we might actually manage a second round as well. So who would like to start? I have one here in front.
Thank you. So I'm Giorgio Primiceri. My question is about financial literacy and this idea that there are many people having no clue about what inflation is and what they expect about future inflation. And I wonder whether there's probably a high correlation between not having any clue about what inflation is and being low wealth, hand to mouth. And so these are people that typically don't make any important decisions. Well, no, wait, let me revise this. For instance, these are not people who have a huge amount of savings and they have to decide whether to put them in stocks or in bonds, decisions that are heavily affected by current and expected inflation. So my question is, should we really care about this misperception? And how much of this misperception is due to people with very low education, low income, low wealth, as opposed to people with high wealth?
All right, thank you very much. The second question is up here. Second to the last row, please.
Hi, it's Christina Molnar, Norwegian School of Economics. So ideally, people would understand how monetary policy tools are connected to targets. What's the economics linking them? But we see so many problems, even at the beginning, understanding what the current inflation is. What's your opinion? Is it possible? What are the limits to make people understand. It's a lot of the policy work is hinging on this understanding to be able to commit to something and make people understand what they should expect in the future. It's hinging on this understanding, what can be done and what do you think are the limits, in your opinion?
Thank you. And then we have the third question.
Nathan Converse from the Fed. Have press conferences improved central bank communication or maybe just added to the noise? That's for any of the panel who want to respond.
I guess from the Fed you would have to answer yes, right? So maybe we go the opposite direction, that Silvana starts with reply and then Ricardo and then Luisa.
So Giorgio, that's a very important question. So low income, low education people will probably have a very small impact on the macroeconomy. So from a macroeconomic perspective, those biases won't matter. Now you say they're hand to mouth, but maybe they are hand to mouth because they are over-consuming. And they're over-consuming because they have this perception that inflation is much higher. So when you look at the low education, low income groups, the gaps are much higher than the average in terms of perceptions and expectations. So they have inflation expectations of around 6-7%, which might explain why they're hand to mouth. Now, as I said, this is not going to have a macroeconomic impact, but we can improve the decision making of the most vulnerable segments of the population by perhaps trying to improve financial literacy on those segments.
I make 3 comments in 3 minutes. First, rational inattention theories, or just generally inattention theories, or actually even more broadly, imperfect information theories, by and large have a very strong prediction, which is you want people not to pay attention to you, because paying attention is costly. You want to say inflation is going to be 0% or thereabouts with error, and you don't have to know what inflation is, what the forecast is. You don't have to know the name of the distinguished gentlemen and ladies serving at the central bank. Just trust that price will be stable. That is what's optimal in these models. And so in a sense, I don't think it's necessarily a better world, one in which where people know exactly what the central bank is up to or not. It's enough for them to trust that prices will be stable. Again, 2% inflation, 1%, as long as these prices are stable and behave accordingly. And that would be at least what theories of imperfect information suggest is optimal. It's not optimal in those models that people know a lot, actually. So in the sense, more than the limits, it's not even optimal that they know so much. But on that, and elaborating a little bit on that also, let me use or perhaps abuse an example that I used last year at the Sintra conference and published in that regard, which is there are few things that are much more important to any of you here in the audience than what inflation was in the UK or whatever country you come from in the last year, is how many calories you ate in the last month. It's just more important for your well-being. How many of you can tell me how many calories you ate in the last month? How many of you can tell me how many calories you should be eating per year in order to have a healthy diet given your size and weight and not? And most of you, I won't embarrass you to ask to put your hands up, but most of you cannot answer either of those 2 questions. Those are extremely important questions for your welfare, for your individual welfare. Now, the fact that most of you don't know, does that lead us to think that, therefore, we don't know anything about calories, we should not teach them about calories, about the economics mechanisms that links calories to weight and to health and others? Or just generally, should we just make speeches where we say, trust us, we'll take care of your calories, eat whatever you want? No. We react to that by investing enormous resources in educating the population about not the economics, but in this case the biology, the physiology of how it is. We engage in extremely costly policies of labeling of every food in terms of how many calories, how many proteins, and whatever, no matter and the different ingredients that come in different food. And that seems to me like those guys in the calorie business, they're right in terms of public health. And we keep on trying. And I think people now know much more. And we have even private sector contributing with lots of apps for you to count your calories and know exactly what to do. And that seems to me to be the right direction. And I think central banks would do well to emulate that one. And then very briefly on your monetary fiscal, the central monetary and fiscal policies are not necessarily the same as monetary and fiscal actors. The central bank itself, even if it is a monetary actor, can also engage in fiscal policies in themselves. And so as a result, while coordination with a different actor
is desirable and needed and important for ultimate outcomes, the central bank within its toolkit has quasi-fiscal actions.
Marcel, I realize I didn't answer your question. So briefly, and it connects to Pietro as well, George as well. You said, well, the fact that they have higher inflation expectations can help us with wage negotiations. And I'm going to say no, because those with the very high expectations, again, are the low-income, low-education groups or women, and those tend to have lower bargaining power and lower say in wage negotiations. So I don't think that's going to be the way.
Well, if you allow me, I want to ask a question to the audience. How many of you are subscribed to Netflix? Can you raise your hands? Okay. Have you seen the evolution of the price of Netflix over the last 3 months? Have you realized? Well, inflation is inflation, but you have perceptions, and afterwards you have indexes. And, statistical authorities, they try to gauge and to, how the retail prices are evolving. And sometimes they lag behind, the reality of the different households. So, these are three different questions. Because, both Silvana and Roberto, they have focused on inflation expectations. But when you have to take decisions, real decisions, you have to look at a broader range of expectations. For instance, interest rates, for instance, the exchange rate. These kind of things is not only, inflation expectations are key, but there are other kind of expectations that are relevant. And the point that I wanted to make is twofold. The first one is that we have to be careful as central bankers, because what I have defined as the echo chamber effect is relevant. Sometimes after a press conference of a central banker, you realize that markets start to follow the messages put forward by the central banker. So you have to distinguish between the real market expectations and the influence that your communication is exerting in these market expectations. And secondly, is volatility. Market expectations are volatile. So my point is that you have to be careful. We have to focus not as much in market expectations. Market expectations are relevant, but we have to be much more data dependent. And because otherwise, if market expectations are volatile and you follow closely market expectations, perhaps policymakers will start to be volatile, and this is something that you should avoid at any price. And you said something about interest rates, no? And well, I think that the situation is quite clear. Now, we have applied, a very expansionary monetary policy all over the world. That's the situation. I think that we have started to reap the benefits of this policy so far. But, let's see what happens in the future. I think that we have to act, I would not say aggressively, but, with a lot of determination. And if you look at the actual inflation rate in the Eurozone, for instance, is 1.1%. And if you look at the headline, inflation expectations, is around 1.2, 1.3, depending on survey-based or market-based inflation expectations. But the point is very, 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 very clear. We are going to have low rates for longer.
I think this is a very perfect closing word, and we are at the end of the session. Thank you to all of you for coming, and please join me in thanking the three panelists for a very fascinating talk. Thank you.